Good evening, ladies and gentlemen. Welcome back to Walk the Block, where we are navigating digital finance together. And let me say, the seas have been churning, so to speak, but it's been largely to the upside. So the sky is not falling. A lot of big things happen. Big moves all around. That's the title for the show tonight. We got the Federal Reserve came out and had their press conference last week after their meeting. We also have an announcement of a U.S.-China trade deal. We'll be covering all the details on that one. And finally, what you probably care about the most, crypto's pumping pretty darn hard. Bitcoin's back over 100K. Ethereum is finally down, or finally up from being down and out in the dumps. And a lot of the altcoins had big moves as well. We're going to be covering all that and more tonight on the show. I'm your host, Zenith. Welcome back. Glad to have you all here with me. And I'm joined by the three-man show today. We got Agent J. How you doing, buddy?
How's it going, gang? I am doing fantastic. Had a great start to the week. Did a market open stream for the DGen Roundtable this very morning. Just trying to keep them abreast of exactly what's going on over in crypto Twitter, because we had a whole bunch of nonsense come out about an apparent escalation with China, which turned out to be a whole bunch of fake news. So it was a big case study on asking AI, because AI makes your life easier for you, because AI actually pulls the sources to verify these claims that were going around crypto Twitter. So the TLDR is it was absolute nonsense. Scott Bassett did say that, but it was early in April once both countries retaliated against each other. And as far as I know, things went pretty swimmingly over at the meeting between Bassett and the CCP representative in Geneva. So we're going to go over the details of that, I'm pretty sure, later on in the stream. But that's pretty much the subject that we covered. And also the potential bearish scenario finally forming on the local structures for Bitcoin, which we'll go over if time permits later on as well.
Excellent. And I'm joined by our third musketeer. Tracker, how you doing, buddy?
Doing good, guys. As always, looking forward to Monday. Yeah, there's some really good information we've been circulating with the DGen Roundtable, but even in more detail, stuff that Jay and others have been sharing within our Walk the Block membership chats have been really interesting. We've been brewing up some new ideas. Maybe if we have some time today, we'll talk about some of the new stuff we're going to start adding in there for our members, because I'm excited about it. We've been kind of holding back on a lot of things. So now that we've got things rolling, it's going to be fun to start sharing some of that stuff we're in the works. So looking forward to that too. And as always looking forward to Mondays to talk about macro events and what's going on, because crypto and regulation is never lacking of stories. That's for sure.
That is very, very true. And by the way, shout out to everybody that got into the private Telegram. Y'all are awesome. We're super glad to have you guys. And we are pumping out as much content as we possibly can to give you guys good value. That's the goal over there. Trying to get everybody on the same page so we can all win together. I mean, at the end of the day, that's what we're trying to do. So shout out to all you guys getting in there. And then shout out to these guys as well. Some absolute studs over here putting out great content. Outside of that, though, we have some of the other studs in the chat. We got Moonpilt Rational Optics saying, "What's up, gentlemen?" He also is saying, "Everything is fine. Everything is fine." I would agree. Everything is fine right now. And then he also says, "FYI, everyone here so far has hit the like button." Well, I'm going to have to refresh our numbers, but I'll see. But yes, if you don't mind, please do the YouTube pleasantries. Like, comment, subscribe, share it to a friend if you like what we have to say. If you think we do something extra funny or have a witty insight, please feel free to clip the show. We don't mind at all. And another good friend of ours, Centurion 54X, said, boys. Good to see you, sir. Glad to have you here with us. Alrighty, gentlemen. Well, it's crazy to say that it's not even a week old, but it feels like it might be slightly old news. But we are going to go ahead and start off with the Federal Reserve press conference. We have our boy Jerome Powell coming in. Spoilers, they didn't change rates, so we had another month of no cut. But I think we do have an interesting setup for June and possibly July. We'll have to see what the numbers and what our prediction tools have to say. But outside of that, ladies and gentlemen, the man of the hour.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the
Gonna skip ahead and get to the good stuff real quick.
outlook and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent.
All right, there you go. The opening clip. Apologies for the long one there, but that's pretty much your summary. And it actually covers the main point for the meeting this time around, which is talking about the balance of the labor market and the effect of the tariffs. So, gentlemen, we had no rate cut this time around. Were you expecting anything different?
No, sir. Across every single reputable source, the CME FedWatch tool predicted us at about 97% hold. Polymarket and Kalshi were anywhere between 94 and 97% that we were going to hold, which was well within the expectations for May. So no surprise there.
Fair enough. Tracker, I'm guessing you were also not surprised.
Not surprised. I think we were more interested to see what he was going to allude to, maybe tipping his hat on, on the next rate, the next time that they meet on the outcome. But I don't think we really got a whole lot out of it. To me, it seems like, hey, in his mind, everything's on track, everything's going as planned, basically stay the course. He doesn't. Jay, I'd like to know your intake. Did you feel like he tipped his hand at any which way? I didn't see anything that jumped out to me saying outside that he just feels like everything is just moving along as he expects. Nothing to see here.
From the opening statements, there were a few things that really caught my attention. One in particular, when he mentioned the GDP numbers. So he, admittedly, right, it's hard to deny that across all estimates, all institutions making the estimate, GDP went negative for Q1 of this year. And he gave the reason was that the tariffs made the calculations for the numbers somewhat complicated, although fair, because we know, he said this before, that it's very difficult to parse out the numbers that are going to be caused by inflation because we don't have enough data yet. And even if we do have the data, those numbers are going to be difficult to parse out regardless. So that's fair. However, at the end of the day, the TLDR is we had negative GDP readings, and that's what the market cares about. The market doesn't care about the tariff situation complicating your numbers. The market cares about, we got Q1 negative GDP. If Q2 is negative, guess what? Definition of a recession. So that's one thing in particular. And then the other thing is, he did mention that there is now, admittedly, a threat for both rising inflation and rising in unemployment, the details of which he goes over a little bit later on. But we finally have an admission there, right, of the potential actual threat to both the dual mandate of the Federal Reserve. But aside from that, man, same old song and dance. Labor market data came in as expected. Inflation data he's going to go over later on, and I'm sure we'll go over those in the particular respective clips and questions. But those are the two things that I honed on, right? The threat of tariffs to their dual mandate, and then the whole tariffs made Q1 GDP calculations complicated, but really nobody cares, man. They cared that it was negative.
Definitely. Based on what they're talking about this time, in one of the clips I'm not going to show, but they do ask him if they're going to revise their numbers for the increase in inflation risk as they talk about. And he says, no, you're going to have to wait till June when we actually put out the full PDF document of revising our estimation. So we're not getting that this month, but we are getting it next month. So as it stands right now, everything from the last meeting back in March is still holding. But outside of that, some of the major questions that we deal with here are pretty much going to be, what do you see as a potential risk coming down the pike that you might or might not cut rates for? And he says right now, they see that the labor market is in a healthy spot, and they think inflation is a healthy spot as well. It's higher than they like, but it's in a healthier spot. At the same time, the whole unemployment rate is also of the question, and they're pretty much making sure that whatever they do, it's not going to cause the other one to go out of control if that is what they show. But we will go ahead and move on to our second clip here.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, and economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economy. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is, we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
All right, there you go. So, started off talking about whether or not they need to move fast because the data is lagging. And, well, he repeated as one of his favorite lines, which is that we can afford to wait. One of the big critiques of Jerome Powell in the past that he's waited just a hair too long on making those decisions. And it seems like he's going to be kind of doing the same thing here. So, does that give you guys any hope that we might be cutting rates in the future, or they're just going to keep sitting on it, or what?
That's not a fair critique, to be quite honest. I
Okay.
dislike it when they say that Jerome Powell. I get where it's coming from, but and so I dislike the critique number one, and I dislike the question number two. It was a silly question. It was a stupid question. The question was, why can't you get ahead of it using the sentiment data? Why do you use the hard data if the hard data is indeed lagging? Well, let me ask you something. Hypothetically speaking, if I had, let's say, the best theoretical team in basketball. I had every single position filled the way that I wanted it to, right? I'm the head coach. I got I got Kobe Bryant at guard. I got Stockton running point. I've got Shaquille O'Neal in center, and he gets along with Kobe. I've got Tim Duncan, power forward, and I've got Kevin Durant at small forward. That's a team I'm working with. That's a pretty competitive, like Olympic level championship team. And so I know how they're performing. I know how they're working together. They're giving me consistent results. And so I'm going to base all of my plans, all of my training, everything, how my opponents are going to react to them. I'm going to base everything around the team, around the data that I have now. Let's say owner of the team comes to me and say, "Hey, we might get Jordan, right? We might be able to get him. His free agent period is expiring. We might be able to get him, kind of, sort of. We don't know. We got to negotiate. We don't know how much he's gonna ask for." Like, I'm like, okay, cool. If that happens, it could certainly be beneficial, right? Or it could be negative, depending on how it interacts with our team dynamics. But I, as a head coach, would I plan on having Jordan on the team when that is not a possibility and the negotiations haven't even happened yet? We don't know how much money he's gonna ask for. We don't know if he's gonna fit in the team. We don't know how he's gonna interact with the team. What am I gonna plan for? Am I gonna plan for the team that I have now and build a championship contending team around the players that I have now, or am I going to theoretically build around having Jordan in my lineup? And the answer is pretty damn obvious, right? I'm going to build around the team that I have now because that's what I have data on. Apply that to any other analogy that you possibly could want. Apply that to business, apply that to anything. It's the same exact damn thing. Jerome Powell does not have the luxury of trying to be proactive with Donald Trump as president. There's absolutely no way. I certainly wouldn't do it in his position, especially since, as he mentions later down in the stream, we do not yet know the size, the scope, the magnitude, the time in which they will be implemented, and to what scale they're going to be implemented. And so how could you possibly expect that man to plan around the volatility of Donald Trump and the uncertainty of tariffs? There's absolutely no way. That was a silly question. You should know better as a legacy media reporter. But I guess, like always, we're expecting too much from our legacy media reporters.
I will say, if you think it's a foolish question, then there were a handful of fools in the room for that press conference. Because the reason I picked this clip in particular is that I think she was like the third or fourth person to ask about like comparing soft data versus hard data. Because what she's referring to is that there's a lot of sentiment surveys that go out, and a lot of the sentiment surveys have been saying that the people feel the economy is not in a great spot. Whether they're pointing to the profit to earnings ratios on all the stocks, talking about the factors that are not measured inside of the unemployment rate, and then also persistent inflation. Meanwhile, Jerome Powell is trying to be data-driven on stuff, and he's talking about how, like, I need to see it in the numbers in actuality, not just how people feel. So, again, this is like the fourth person to ask this question, but she did a pretty succinct job at it, which is why I picked that one. But, you know...
Dude, also, regarding sentiment data, he said that the sentiment data very rarely reflects the actual hard data. Exactly. People say that they're scared about inflation, but their spending habits don't change. They still go out and buy cars. They still go out and buy luxury goods. So it's like, what? are you expecting me to act on unreliable like the sentiment data? I'm not disregarding the importance of sentiment data. And he's also said that, right? The sentiment data is very important to get it's like a initial litmus test of how people are feeling about the freaking economy, right? But if every single time you get the sentiment data, it tells you that, you know what, people's behaviors, usually they still act in complete opposite to what they actually say on these surveys, then why would I try to plan around that? Silly.
Tracker,
I
what do you
got a
think?
question. What happened the day before? Before he spoke? Jay, Xanth, you guys were all over this. What happened? Who was buying up? How much money was bought up in the
It
bond
was the New
treasury
York
market?
Fed. It was the New York
New
Fed.
York Fed bought up how much?
Between a span of like 36 hours, bought a total of about $34 billion worth of U.S. securities, broken up between 3, 10-year, and 30-year notes.
That would have been a viable question to ask his thoughts on that in the meeting. I mean, they're not asking the questions. They're not asking the hard questions. They're not asking the questions that it just feels like it's just, I don't know. I mean, honestly, with the original administration, it felt like everything was screened very heavily. But here, I'm surprised, I mean, Trump wants to tip his hand. I'm surprised he didn't have some media people and they're asking those type of questions. Or I find it hard to believe that the people in the media that were there did not know about that happened the day before. I mean, that is a staggering amount.
Well, it's whether or not they know about it, and also if they understand what it means.
Yeah.
So, I mean, they're reporters, so they're trying to focus on the stories. A lot of their stories are trying to be headline and attention grabbing, and largely emotionally driven. And the question really asked about the market sentiment, which is emotionally driven. But I think Jerome really hit it on the head there, which is like, look, we've had bad market sentiment data in the past. The connection to that and actual like results at the end of it are very weak. He's seen it in the past. He's anticipating the same thing to happen this time. So for him, until it changes, it's just going to be kind of more of the same.
Yeah.
All right, gents. I do have what I think is a better question because it actually gives a little bit of a different picture about 2025 versus 2024. So here we go.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course, that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
All right, there you go. So the question was, talked about Jackson Hole last year, talking about the rise in unemployment. What's changed? Well, this time around, we pretty much are a full percentage point higher in unemployment, and we still have a bit of the inflation stuff going on. But at the same time, I think he hit it right on the head there, which is that they've gotten to a point where inflation is down enough and unemployment has also risen enough that he sees them in balance. And for him, the correct answer at that point is wait and see. So that's why you also slightly get the answer for his other stance, which is sentiment versus hard data. Well, we'll just wait and see. So here we are. How do you guys feel? Is 2025 looking? How do you guys feel about the situation in 2025 versus last year?
More certainty in more ways than one because of the volatile president, and obviously with all of the trade war shenanigans. But at least the pathway for crypto is much clearer than if we had somebody else besides Donald Trump up in the Oval Office. There's that. But the other thing that I wanted to focus on is the question is, a lot of people on crypto Twitter are harping on him about like, why are you not cutting rates? And you just nailed it right there on the head, Z. You have a labor market and you have inflation numbers that are directly in balance with each other. You have unemployment hovering consistently around where the Fed determines it to be a healthy unemployment level. Further, you have inflation heading towards their 2% goal. If you are Jerome Powell and you're looking at these numbers and you're getting consistent readings quarter over quarter, month over month, why in the heck would you make any major moves? If you're getting exactly what you want, why are you going to make any major moves? It does not benefit you at all, which is why he keeps saying if we have to make a move, we are in a good position to act. But they are not going to do so because they're getting the numbers that they want.
Well said, sir. Well said. Tracker.
At least cut QT. At least just say you're going to at least end QT. I mean, something. It would be nice. But that's really what everybody wants. Well, everybody wants him to pump our bags. Let's just call it what it is. He's not there to do that. He is there to try to run it in this very delicate balancing act. And he doesn't have to act right now because the things are in line. But once those things take place, he has a lot of leverage. He can cut QT. He could start doing QE. He could be unaggressive during QE. He could be aggressive in QE. I mean, there's so many. I'm sorry, not QE. I apologize. Cut QT. He could cut rates, not aggressively, just a quarter point here and there. He could be more aggressive, and then finally it would be QE. So he's got a lot of ways to go before we even should be hinting about QE. Yeah. Like I just want to hear. I would love to hear him just come out saying we're going to stop. We're going to cool it on the QT. We're going to stop QT and give me 3 rate cuts this year. I mean, that alone, I think would be that'd be a great start if we get it, but he's not going to do it until he's data driven. He's very robotic in that sense. He's not going to take action until the data says what it is.
And you know what it is, Track? If he does decide to say, yeah, you know what? You caught me. We are actually going to say that we ended QT and we're doing stealth QE. Or even if you just say, you know what? Yeah, cutting the runoff of the balance sheet, which means basically end of QT. You know what that's going to do? It's going to pump the markets, which could potentially increase the probabilities of a resurgence in inflation. And so what you had was numbers that you wanted, was getting numbers that you wanted. And now because you're like, you know what? Let me just give the market what they want. Let me just go outright and say, I'm going to stop QT now. It's like, well, I'm already getting what I want. Why would I put that under like pressure? Right? Like if I'm in his position, I care about monetary policy. I don't really care what the market wants. I really don't. If I'm getting the numbers that I want, I don't care what the market wants.
That's true. By the way, there was another question where they specifically asked him about refinancing the debt, and he was like, "Well, we care about monetary policy, and I'm not going to tell Congress how to handle fiscal policy, so that's kind of up to them." So yeah, he's very happy to focus on what he's focused in on, and he's kind of trying to exclude all the rest of the chaff. But for me, this clip in particular is one of the more telling ones for kind of the future of what they're going to be up to, which is that he's saying, "Look, we're in balance for our mandate right now. We're going to wait and see if something changes, but overall, we can absolutely afford to wait." So we came into this meeting thinking that we're going to get 2 rate cuts this year. After this meeting, I think that 2 cuts is possible. I think it's definitely going to be delayed, though, at least based on the sentiment going on here. And until conditions on the ground change and actually kind of like put a little more pressure on Jerome Powell to really get going with that dual mandate, I think that he is more than comfy sitting right where we are. Granted, there is still, I know I'm sad, there wasn't any mention of R-star at this press conference, which is the neutral rate, which is where they believe the rate should be to not be overly restrictive and overly easy. So until something like that changes, I think we're going to be sticking around right here. And as far as the crypto folks care about, which is us, by the way, yeah, you've probably been hearing us talk about it for a while now, which is that quantitative easing is very much correlated with the crypto markets pumping. So what we're seeing here is that based on the Federal Reserve actions anyways, quantitative easing is not going to be coming for a little bit longer than we initially thought, which means it might have some effects on the crypto market. Yeah. But I will say, I think that one of the reasons why we might also be seeing this, granted this press conference was before the news came out, but we did get some new news going on, which was, this guy. We had a historic trade win for the United States. That's right. Over the weekend, the United States and China appears to have penned a deal for a trade deal. This happened in Geneva. This happened after the press conference. But at the same time, this does relieve one of the big pressures that they were talking about inside of that press conference, which is that tariffs are a cause for potential slower GDP growth, higher unemployment, and higher inflation. So with possibly one of the biggest trade wars out of the way now, being China, that should theoretically reduce pressure on that, which again cycles back into what Jerome Powell just said, which is that as long as the inflation and the unemployment remain in balance, they can afford to wait. Here you go. Here's one of the biggest problems that appears to be solved. So coming to us from the desk of the White House, we have the fact sheet for securing another historic deal. Today, the United States issued the first joint statement on trade in many years with China after successful negotiations over the weekend in Geneva, Switzerland. Both parties affirmed the importance of a critical bilateral economic and trade relationship between both countries and the global economy. For too long, unfair trade practices and America's massive trade deficit with China have fueled the offshoring of American jobs and the decline of the manufacturing sector. In reaching an agreement, the United States and China will each lower tariffs by 115% while retaining an additional 10% tariff. Other U.S. measures will remain in place. Both sides of these actions will take place on May 14th. So the Chinese actions are going to be the initial, China will also suspend its initial 34% tariff on the United States that was announced on April 4th, 2025, but will retain a 10% tariff during the period of pause. For the American side of the house, they will suspend the 34% reciprocal tariff, but will retain, again, the 10% tariff during the pause. So what we're seeing here is that, I guess we'll just hit the conclusion here. So working towards a rebalancing, the U.S. goods trade deficit with China was $295 billion in 2024, the largest with any trading partner. Today's agreement works towards addressing these imbalances to deliver real, lasting benefits to American workers, farmers, and businesses. As our nations continue these discussions, China will be represented by, I'm going to butcher this, He Lifeng, Vice Premier of the State Council. The United States will be represented by Scott Bessent, Secretary of the Treasury, and Jameson Greer, the United States Trade Representative. All right, there you go. I know we got into a bit of a tariff war there initially with everything going all the way over 100%, but now we're getting the nice headline of tariffs reduced by 115%. The bottom line that we came out of the story with is that we've reached a trade agreement, which is pretty much 10% base tariffs higher than in the past. So what do you guys think? Is this going to do its job of alleviating those fears that people were worried about, or is there still more to come?
Yes, it will to some degree. Across the board, we got a ton of reports from a whole bunch of sources in crypto Twitter talking about how the fears of recession have significantly declined. We've had a lot of different pundits talking about how they're estimating that, hey, our our ranges for Bitcoin for this year. If this thing actually comes to fruition, might be a bit too low, et cetera, et cetera. I do want to make a note that this is not a comprehensive trade deal. This is just the start, and also want to take a note that they pushed the damn ball further down along the line again for 90 days. So this is not a comprehensive trade deal. This is not the end of negotiations. This is just the start.
There you go.
Yeah,
Tracker.
this took the worry off the table, 100%. I mean, come on. Remember when this came out, we spiked up to 60 in the VIX. We're now down to what, 18? I mean, it literally has just completely come back into a normal levels for the VIX, which tells us the fear is calmed down a lot. You're getting clarity, which the markets hate uncertainty. I know we always preach to that. You have that. Yeah, there's a little bit of 10% rise on both ends. Okay, but that's minuscule in the grand scheme of things. This is reasonable. This is something that now people can price stocks and other TradFi instruments to try to better prepare. Other companies can try to navigate around a 10% tariff instead of a ridiculous triple digits worth of tariff. So that's easily digestible. On a kind of, it's related, but on a side note, I mean, if you guys ever looked at the Shanghai index, man, that thing has been pretty much stuck in a range. Outside, if you take the jump in 2015, it's been pretty much range bound since 2010. It really has not really gotten running. So if anything, the Chinese market has been stagnant to just kind of going sideways. Not a whole lot of action there. And what I'm trying to get at is the Chinese market is in a much worse place than the United States market is currently. So they needed this a lot more. I mean, it's easy for us to say this, but they really did need this more out of their way than we do, because they're in a really tough bind right now with a lot of reasons. And of course, they also own a lot of U.S. debt as well. So I'm sure, the one thing that hasn't come out of this was how they talked about we're getting this very cliff note high level. We're not getting the details on the back end deals, like how much are they going to basically, once the Fed, if they can get the rate cuts, are they going to allow for various levers to be played for these countries to get them at a lower rate to hold the amount of debt that the U.S. debt that they have on their balance sheets? Things like that haven't come out. I'd love to know more about that, but I don't think we're going to have that, not anytime soon. So, but yeah, the opportunity was presented. Anytime you get these massive spikes in the VIX, that's when you have panic. That's when you want to be, capturing those opportunities. As when the market were dumped, that would be the time to capitalize. And now you're getting clarity. So yeah, I think things have calmed down quite a bit.
I would agree. I think the VIX is a great indicator of that, which, by the way, is the volatility index for the overall stock market. But yeah, Tracker, you beat me to it. That was one of the things I was going to bring up here. Additionally, the S&P 500 had a really good day based on the announcement. Big gap up after the weekend, coming up to 582. Yep. We're starting to look like we're heading towards those all-time highs again if this trend can continue. So yep. Overall stability of the market, I think, is increasing. I know we've been talking about this for a month or two at this point, but we asked the question of how long it was going to take to get to that stable business environment so that we can kind of get back to operations normal. And it appears we might be getting back a little sooner than anticipated, which
I said 2 months. I said 2 months, within 2 months of the whole thing. I thought I was a little bit early, but I feel like there was too much pressures that they had to get this resolved a lot sooner than later. This was basically tip your hand, rip the Band-Aid off, shock the entire world, and get their attention. Now let's get to negotiations, and that's basically what was done.
Yeah, and
there you go.
And here's another thing that I saw circulating around crypto Twitter today, which kind of fueled the positive sentiment, was that we're about 20% above the numbers from Liberation Day, which for the traditional markets, 20% is like, okay, that just basically eliminated, or at least it severely muted the potential of, oh, we're heading to a bear market. So that also funneled the positive sentiment across crypto Twitter today.
Hey, Zian, bring up the Russell 2000. How's that doing? It still has a little bit of ways to come back up, but I think it's trying to play catch up to get back to where it was. That's the one I'm curious about. Are risk on assets? Is there an appetite for risk on? So yeah, of course it gapped up, of course, but it still has a little bit of ways to go. Zoom out a little bit, because I know I want to look at the recent highs. I know we hit close to the recent highs. Zoom out some more if you can, or just go to the low. I just want to say, there you go. So there you go. That
That's
was the
the
all-time
weekly.
high there. It touched the all-time highs. It got up to that one and then got rejected. So the Russell 2000, if that thing can get close to the all-time highs or even start to hint of breaking out, and that looks like a pretty strong move there. Look at the volume candle coming in. That's a pretty good significant amount. So if that thing can get going, risk on. And honestly, you are getting an environment where risk on is there. I mean, that's just why the markets want Jerome Powell to speak, even though he doesn't have to. If he makes that trigger or even just kind of a hint to anything, it's almost a clear path going forward, risk on big time. So that's what everyone's waiting to see.
Fair enough. And just for the uninitiated, those being me, what is the Russell 2000?
It's the small cap index for the traditional TradFi market, and specifically in the United States. There's other small cap indices, but basically these are smaller the cap, the more riskier the assets. It's pretty much with anything when it comes to investments. And this is just an indicator where if you have a lot of people, if the Russell 2000 is starting to outperform the S&P 500 and the Dow, that means people have a risk on appetite, meaning that if people are more willing to take on risk, they have more certainty and clarity on the market. So they're more willing to put on bigger bets that those riskier assets are going to outperform. And that's what, you typically get that one, just those nice mega bull scenarios that start to happen where everything looks like it's clear sailing. That's when it does. And then in the inverse, when, things are going really bad, that'll take an absolute bloodbath. And that's why everybody flocks to the dividends or the large cap stocks in the TradFi markets.
Fair enough. Alrighty. So we spent a good chunk of the show already talking about the Federal Reserve, talking about traditional markets. Both of those things are indicating that we're not going to be getting quantitative easing, which we've been talking about is a big boon to the crypto market when it happens. But I may have a silver lining in the face of not getting quantitative easing anytime soon. And that is that Bitcoin has actually been doing a pretty good run over the last month, effectively, ever since we bottomed out April 7th. So a month ago, since then, we've definitely come towards the upside. That being said, the hopes of quantitative easing are down. Markets are more stable, but crypto is still, in my opinion, I think it's outperforming the traditional markets a little bit.
100%. It is absolutely outperforming the traditional markets, and it's actually performing better than the Russell 2000. Which, if you notice, when everything was taking a nosedive, gold was doing very well during the nosedive, and rightfully so. People flock to gold for many reasons. Now, gold has a lot of narratives, not just a safe haven, but also another place to be because of the inflationary situation the U.S. government has posed on the entire world. So, gold is it's just a perfect environment for gold right now. Well, it's interesting. You started seeing this kind of bleed into the crypto market for a little bit, where crypto was outperforming even the days when the markets were kind of down to flat. Crypto was rallying. So it's definitely, and the Bitcoin was rallying pretty good. And then just recently with the tariff news coming out, that's when Ethereum and others really started taking off. And that was riskier on crypto assets. Got a nice little pump over the last 2-3 days now. But yeah, it's interesting because if you look at Bitcoin, it's pretty much flirting with the all-time highs already.
That it
and
is.
You can't say that for the S&P and the Dow, and it certainly can't say that for the Russell 2000. So 100% it's outperforming them.
True. The question I do want to pose with that little intro, though, is that are we seeing the crypto market actually start to slightly decorrelate from the traditional markets? We've seen a lot of correlation up to this point, but now we're actually seeing that there might be some independent factors happening inside of the crypto markets that are having it pump for separate reasons from traditional finance.
I'll let Jay take that one because we bring this crap up all the time.
Over the past few weeks, it certainly has, or at the very minimum, it certainly has run harder. But whether it does or doesn't, and permanently, I might add, that's yet to be determined. We have spent small periods of time separated from what's happening in TradFi. The most recent one, I think the most recent I can think of is at the very beginning of the bull market when we had the bank runs and the whole world was panicking, but Bitcoin was doing well. So there's that instance, but that was also short-lived. I think the opposite is actually going to happen. The more this, at least with Bitcoin, the more Bitcoin gets adopted, the tighter the correlation is going to become. I think that's a reasonable assumption to make based on the adoption. Right? The more something is adopted, the more it basically ends up lining up with the status quo. In terms of price action, but in terms of like the ethos, I think that's where we set ourselves apart. So
That's fair.
That's my thoughts on it.
I guess another reason I asked the question is we've talked about it on previous shows, which is that I think we're all big believers in the Bitcoin 4-year cycle. And the question has been, why are we at the point we're at in the Bitcoin 4-year cycle? I mean, that was the question back when we were down below 80K there. And now we're starting to see maybe that narrative is having its resurgence, which is that Bitcoin is having some good moves. It appears to start being able to operate more independently. I mean, granted, your point is very, very true, which is that the older Bitcoin gets, the more highly correlated it's going to be with more traditional assets. But as it stands right now, I think we're still in that crypto golden age, which is that it's still very new, very fresh. Adoption is up, innovation is high, and we're getting pretty late in the 4-year cycle. So I think it's a reasonable narrative to actually start asking the question about, which is, are we actually going to start seeing those parabolic gains? And is this the first indicator of such?
Yeah, agreed.
Yeah, I mean, that's what we're all hoping and expecting, right? And I would say, like, I know we've talked about this many times. This year, with all of the new regulation, everything becoming much more clear, very crypto friendly, U.S. government and other governments starting to really get on board and using it as another alternative, mainly for other countries, specifically the BRICS for inflation, hedging inflation. It's just another tool to their basket that they
We lost you, track.
can use to figure out how to get around inflation. That's the big boogeyman, basically. So that crypto and Bitcoin is certainly allowing for that to take place. And now with the regulations, like I said earlier, with the regulations being positive, like, I guess my biggest question to you guys is, what else would need to happen to make crypto decouple or decorrelate? And I know Jay's already said that the regulations and more adoption, mass adoption. Well, you're getting that. TradFi is involved. Other countries are starting to get involved. Trading in non-US dollars is starting to occur. I don't know what else needs to happen except for time. Like,
I have an answer. Something has to break, and it has to break aggressively, and has to happen fast. And by that I mean we all know that the U.S. dollar is being debased, but the inflation that we're experiencing here, even though it is palpable in the daily necessities of living for most Americans, it's not to the degree of what happened in Venezuela when their currency dropped in value so fast that people could not wait to get rid of their money. It has to break. It has to break fast. It has to be aggressive. Until that point happens, I think it's going to, like you said, the decorrelation is going to happen much, much, much more slowly. So that's the caveat that I would put there. If something crazy like that happened, where the U.S. dollar, where our politicians just said, you know what, we don't give a F, and we're just going to inflate into infinity, and we don't care how inflation is affected short term, long term, we don't care. And it happens extremely fast. Then that's when people are going to start looking for alternatives. And I say that because that was the story of many people in Venezuela. Right? Why they fled, why they looked for even for the people that stayed, why they looked for alternative currencies, right? Why they were trying to funnel their income into stocks, and it wasn't just crypto. That's what happened, right? And that's what opened people's eyes, and that's the similar thing has to happen if we want to expedite the process of the world transitioning to crypto, or at least here in the West, right? Because otherwise, not a big deal for most people.
That's true. As far as the mass adoption and conversion to cryptocurrency for more wide scale use, that makes perfect sense. I can give you a short term answer for that question, which is, when are you going to see people actually start flocking to it and see that decorrelation? And I think it's going to be when we start entering the mania or euphoria phase for this 4-year cycle. I think that once you get enough of a critical mass of people that see the green candles, they see it printing, and you get that critical mass of people trying to chase that high. That's when you see it really shoot up. And it's going to be a shorter term decorrelation because it's only going to be like 3-4 months at the most, probably. But that is going to be one of those points, I think, where we've talked about it in the past. You're going to start seeing all those top signals. Everybody's going to be talking about Bitcoin. Everybody's going to be saying, oh, I bought it at X point. And then you're going to see Jim Cramer come out there and say, Bitcoin's going to $1 million. And it's like, that is the point where you're going to see that the tip of the 4-year cycle. You're going to see that real decorrelation there. I don't think we're there yet, but I think we're starting to see some early indicators. Shout out to Charlie of Cultivate Crypto. He did a show, I want to say it was either last week or 2 weeks ago, where he found a handful of clips from some traditional finance guys on like MSNBC and CBS and stuff. And this was after Bitcoin did the move from like low 80s up to about like mid 95s. And guys on there were talking, be like, I don't know, I'm not convinced about this Bitcoin thing. Like, sure, it's doing nice right now, but I don't know. And then one of the other guys is there like, look, I like it. I think y'all are going to change your tune once you cross 100K. But I mean, right now, I think it's getting good. And you see this difference, which is that there are some people over there that are starting to see it and starting to get it and actually like maybe getting a taste of the profits. And then there are still the naysayers and the people that are really stuck in their roots. And once you get that other conversion of those people that are stuck in their roots, I think that's where we're going to enter that euphoria phase. We're going to get that blow off top, and we're going to see everybody and their mother talking about how they bought Bitcoin here, they're into Solana, they're buying Dogecoin, Elon's tweeting about it again, stuff like that. So there's your short-term decorrelation narrative for me. I think it's going to be that last 3 months of the market.
All right, fair enough.
Alrighty. Well, before we get out of here, I do want to talk about the markets a little bit. We did get a request. So one of the guys asked us to talk about the ETFs and liquidations. So real quick, since we last streamed, that was May 5th. Since then, we were at 94,000. We went all the way up to 105 and change, and now we're sitting right at about 102. Didn't quite break down below 100K during the last day, but we got pretty close, about $100,800. And now we're sitting there. If you watched the Degen Roundtable Sunday show yesterday with me and Jay, really broke it down here, talking about the different moves, talking about potential complete 5-wave moves from the Elliott waves cycle side of the house. You can see potential 1, 2, 3, 4, 5. And then additionally, other assets are doing similar things, which shows a high correlation of a trending market, which is what I believe we're definitely seeing here. But as far as the liquidations goes, we actually had an interesting day for liquidations because remember, we just topped out at about 105 in the last 24 hours. Effectively, we've seen the start of a retracement. And as a result, we had about $700 million worth of longs and shorts get liquidated, much heavier on the long side, almost $500 million. If we come down to our chart here to actually compare everything, it's not the craziest day out there. We had a much crazier day over on May 7th when we had a massive move to the upside after the first move up to about the mid 90 range or mid 95 range. But we saw that people started to get liquidated on their longs today. Additionally, when it comes to the ETFs, we actually saw inflows for pretty much the past 2 weeks, and we've had these single days of a little bit of output, those tiny little red blips there. I apologize. I know it's a little hard to see. But those. So today, we actually had outflows for the day, which could be people taking profits. Who knows? On the Ethereum side,
you see the drop box on your right-hand side go back to your bar graph for the inflows, outflows.
There?
Your bar graph, sir.
What am I not seeing here?
I'm not. So I see total Ethereum spot
sorry,
ETF. There
wrong
we go.
tab.
Yeah.
Wrong tab.
Yeah, you see the all on the top right there? Yeah, there you go. Oh, never mind. I thought that was the time scale. Well, that's a shame.
If only they made it that convenient for me on the free
Yeah.
tools. I know one day we'll actually pay for the big boy tools, but we're not there just yet. Real quick, Ethereum ETF. Oh, geez, that's even worse. We had some outflows week prior. Gosh, this is a terrible chart. I'm not going to be able to do that either. Anyways, point being, outflows for the past week after massive inflows the week prior. Today, we saw outflows. Day prior, aka Friday, saw inflows. So that is what's going on with those guys, at least. When it comes to overall price, That's what we got for Bitcoin, Ethereum. A little bit less of a retracement, actually. And I've seen similar things across a lot of the other altcoins as well. We are seeing that retracement, but big up and down for the previous day. Keep in mind this new red candle right here, that is since the start of the show effectively, because the charts operate off Greenwich Mean Time, and we go live right at midnight for the London folks every time. So over the last 24 hours, up and down action, but overall, Ethereum on the daily for the RSI still in above 75 there, sitting at 76. So have to see what it does there. For Bitcoin, the RSI has dipped a little bit below, and now we're sitting back under the moving average for the RSI itself there. Jay, any thoughts on the TA? I know you mentioned there might be a bear narrative starting to form, which is the start of the correction that we're seeing here.
Yeah, absolutely. Let me go ahead and share my chart. I'm going to go over the bullish and the bear scenario for Bitcoin. For those of you at our member section, there should be a little bit of a review for you because I went over the smaller time frames a bit earlier during the day. But let's give the folks a bit of an update because we've had some developments in the chart since that update this afternoon. All right, so first and foremost, let's actually go ahead and go over the easy part, right? The easy part is the bullish scenario for Bitcoin. We're over here on the 1 hour chart. So on the 1 hour chart, the bullish scenario is we have a WXY already completed for your wave 4. We have a 3-wave move in W. We have another 3-wave move zigzag in X. And then for your Y, it is an ABC flat terminating in a 5-wave impulsive move to the downside in your wave C, accompanied by that volume. All right, so what are we looking now for the bulls if we're looking to take the local high at $105,000 for the bullish continuation to the upside? For that, let's go ahead and go into the smaller time frames, into the 15-minute charts, right? So for the bulls, here is your potential scenario, right? You have a completed impulse to the upside. That is going to be your wave 1. Oh my goodness, that is a terrible. That is going to be wave 1. And now we're looking for a 3-wave corrective move to the downside. A, B, C looks like to be a zigzag. In this particular scenario, what you'd like for price to do is for price to find support somewhere in this green box that is between 107.7 and 102.1K. That is the 0.5 to 0.786 Fibonacci retracement levels, which is a common retracement level for your wave 2, which is what we're looking for in the bullish scenario. Invalidation for the bulls is the 886 at 101,619. That is your hard invalidation for the wave 2, in which case we look to take the local low at 100.8K. Right. So for the bulls, it's pretty simple. You want this move to become impulsive. So you want a 1, 2, find support at the target box. 3, maybe get rejected here at 104.4K because that's your daily naked point of control. Have another small move down, and then eventual continuation to the upside in a wave 5, continuing the bull trend. That is your bullish scenario. Now, the higher probability bearish scenario is the following. We have 2 actually, but let me give you the higher probability scenario at this current moment in time. The higher probability bearish scenario is this one. You have the start of an impulse already complete for your wave 1 to the downside. 1, 2, 3, 4, 5 to finish. And now you're looking for a corrective A, B, C zigzag to the upside in your wave 2. Rejection, most likely, at this red box of resistance. Once again, the 104.4K serving as a major area of interest for resistance because that is the daily naked point of control. Before eventual continuation of the new trend to the downside, and you're looking for an impulsive 5-wave sequence to the downside in your wave 3, accompanied by a significant amount of volume, potentially taking out your volume candle high over here. As it currently stands, this is your highest probability bearish, higher probability bearish scenario, because if you actually take a look, if we zoom out here for a little bit, the last time that we actually had an impulsive move to the downside on a move down, it has been quite a while. Because take a look at it here. That is a range bound structure. That is a range bound structure. This is a range bound structure. This one is a range bound structure. All right. We have not had an impulsive move to the downside since over here. And this was back in this was last Sunday. This was last Sunday. Right? And even here, this is a very awkward count for an impulse, although it does work. So as it currently stands, we have not had a convincing move to the downside for an entire week for the bears. This is the very first one. So what do we look for? Well, like I mentioned, you're looking for price to get rejected somewhere around the daily naked point of control. You're looking for this structure, this move to the upside, to be corrective in nature, 3-wave-ish. You're looking for the volume to the upside to be weak. And not only that, if we switch over here to our CVD charts, you're looking for continued bearish divergences on the CVD. For those of you who caught the afternoon update, and for those of you who caught the morning stream, you know that we actually finally had a bearish CVD confirmation for a potential short entry. Lower highs on the price, higher high on the CVD indicator, confirming a bearish CVD divergence. And our goal, our take profit, was just taking out the swing low over here. And as you can see, that turned out into a nice little short entry position for those of you who were willing to enter that trade. So this is what we want to see more of. We want to see more bearish CVD forming on our momentum indicators to accompany a corrective structure to the upside. And you want any moves up to be very, very small in volume in terms of the buying pressure. All right, so those are the three things that we look for, whether you're looking for moves up or you're looking for moves down. If you're looking for continuation of a particular trend, you want to see, hey, do I have market structure? Do I have volume? And do I have divergences on the CVD charts? Right. That is the three indicators that I always look for to determine entries in a low risk, high return trade. It's always going to remain the same. So at this current moment in time, this is your highest probability bearish scenario. What would invalidate this scenario? Well, very simple. If you take a Fibonacci retracement tool from the very start to the end of this move, your 886 at 105.2K is the hard invalidation for your wave 2, right? Because this is we're looking for this to be a wave 1, and we're looking for this to be a wave 2. If you take out the 886 on a balance of probabilities, you're going to take out that swing high at 105K. So those are your two highest probability bullish and bearish scenario on the local time frame. The bears came out strong with a good start, impulsive moves, accompanied by volume, accompanied by local bearish CVD divergences. So it's a good start for them. Whether they can maintain the momentum or not, yet to be determined because it is very early on in the move.
Well said, sir.
And for those that have no clue what the hell Jay just said, we'd highly recommend you getting in with the Walk the Block membership, because we go into a lot of this stuff and we're teaching people from different levels too.
Oh no.
Foreign to you, then please get involved so we can help explain that to you. But Jay does a great job on the TA as always.
Apologies, tracker. I think I accidentally clicked the wrong button and I took you down instead of Jay's screen share. But yes, if you want to learn more about this, Jay does the Market Open stream pretty much every weekday, and excellent information and breakdown of the technical tools that we actually use for our analysis on the charts, and also looking at some fundamentals. Jay, what time is that at?
7:45 a.m. between 7:45 and 8 a.m. MST. We usually go for about 30 to 45 minutes on average. Sometimes it gets long. Like we did an emergency stream on Saturday that went on for 90 minutes because of the bullish news over the weekend with China and the US. But we average about 30 to 45 minutes every single day, or as time permits, 7:45 a.m. MST every single weekday.
Love to hear it. And like Tracker mentioned, we did launch everything. So The waters get rough, so don't sail them alone. Come join us as we navigate digital finance together. Private mentorship, exclusive live streams, question and answers, go from beginner to intermediate to expert with us. For a limited time, you can lock in our opening price rate of $25 a month. It's good for the first 25 members or until June 1st. Either way, so you can find the link over at our website, which is also in the description down below. But that is where you can find all of us, where what we're doing, and all the latest and greatest whenever it comes to anything finance or even macro news. Shoot, I know when we had the news deals of the China-U.S. trade stuff coming out, I think we were very quick on the ball there, talking about that and everything else going on. Anything else in there that I forgot to mention?
No, sir.
We
I think
have
you
a
covered it
private
pretty
all the action happens in a private Telegram. And then also all the streams that do happen, they all get recorded. And then one of our fellow DJs have been helping us out, Will. Thank you. Appreciate all the work you've been helping us out with. He's got an AI tool that's transcribing and consolidating all the notes from those video streams down to very quick and concise cliff notes for you. So there's so many things we've got working in that we're cooking in the kitchen that we're excited to keep getting more stuff out. So the whole point is, we just launched. We're starting to get feedback from some of our users. We are letting the users tell us what they want. So we are trying to build and make this an easy journey for all of them, so that no matter where you're struggling or where you are, the whole point is we're trying to give you a good ROI. So that's what we're trying to achieve. So please join when you can.
Absolutely. And massive thank you to everybody that already got in there super early. We were stoked to see so much excitement about it. And if you're having any issues with any of the stuff going on in there, please reach out to us. We'll try to make it right as quickly as we can. Might be working out a few kinks there, but overall, I think we have a good system down so far. So we look forward to seeing you guys there. Outside of that, though, don't be afraid. We're not going anywhere. We're going to be streaming on Mondays, 8 p.m. Eastern time every week, covering everything from the macro to the crypto and anything in between. That's what we got going on over here. Mr. AZJ, where can the folks find you on your socials?
All of you can find me over at Instagram at agent_J Schroth, on X at _P90Hex. But I spend most of my time in the DGen Roundtable Telegram chat, in the Walk the Block member section Telegram chat, creating content for those folks on a day-to-day basis. Like Zenith said, just because we are doing a separate thing from DRT doesn't mean that we're going to disappear. You're going to find me doing my daily streams there. And over at Walk the Block member section, it's just more of the stuff that you already like. Technicals, fundamentals, on-chain data, altcoin requests. There is something for you to find there, whether you're a beginner, intermediate, or advanced trader or investor. So go ahead and join or have fun staying poor. I'm just kidding, man. If it's not for you, bro, that's totally fine. No hard feelings. This is just, if you like the content that we produce here on a daily basis and over at DRT, just more good stuff for you to find there, and friendship.
Sure. Tracker, final word for you, sir. Sorry, I know I cut you off there.
No, it's no worries. No worries. Yep, Walk the Block. You can find me in here, and also the DGen Telegram. There's other channels in the DGen Telegram that we're involved in as well. So there's a little bit in there for everybody. I did want to bring up something on the ETFs, though. I'm starting to see now they are starting to come out with double leveraged ETFs around crypto, and I know triples are coming. For those out there that are buying ETFs in that field, be very careful on what crypto ETFs you're buying. There's only probably a handful out of all the ones that are out there that are worth anything. Most of them are U.S. Treasuries and bond backed. They're trash. Be very careful. Open up the ETFs. Look at what they're actually invested in before you just go in there and blindly buy anything. If you are using TradFi, for example, and those leveraged ETFs, be very careful. They do reset on a daily, so they always, regardless if there's an inverse or a bull, they are always gravitating towards zero. This is why the TradFi likes to short them both, because they make money on both sides of it. But if you are a trader, it is like trading on steroids. Put an example, that big ETF move where ETH made what, an 18% return on that day. The double gave you a 36% return. But just be very careful in trading those vehicles. You can get completely destroyed on those. That's because you're getting in the derivatives market. That's pretty much what they're exposing you to. But outside of that, you guys can find us here on Mondays, of course, and like I said, we're really working behind closed doors on trying to get a lot more stuff out for Walk the Block, and keeping up with, I'm trying to pop in there when I can for the streams that Jay has on the daily to try to stay plugged in and just stay connected like everybody else. And that's where we are. Busy times, but it's been fun.
Absolutely. Busy times for sure, but fun times. And I think there's even more fun times ahead. 4-year cycle, I think, is still looking strong in my personal opinion, which has been my the predominant strategy that I've been using. So hopefully we can see that finally pay off here in the near future. But outside of that, do want to give one final shout out. We got KRJ Crypto coming in here saying, hello, friends. Good to see you, sir. I believe this is your first time chatting, so wanted to hit you and say welcome. If you have any questions, you can always ask them in the stream, or if you get in the private Telegram, that's where you're going to get the best answers and a lot of data and sources to back all that stuff up as well. Outside of that, though, folks, you can find me over on X and Instagram at ZenithDI. Outside of that, me and Jay are doing the DGen Roundtable streams as always. But until we catch you guys next week, 8 p.m. Eastern time, by the way, hope that everyone out there continues to navigate the stormy seas of digital finance all together and very well. So we'll catch you guys next week. Ladies and gentlemen, good night.